Chris Pultz, it's been a big year for deals, from tech to telecom to insurance. Will this continue in the second half, especially if we get higher interest rates?
Well, we've seen record volumes, or almost record volumes, throughout the first half of the year. I think we were at $2.3 trillion for the first half versus 2.4 for 2007, which was the last record year. As interest rates rise, as most people expect that they will, it still should continue, but it's actually excellent for our business. The merger arbitrage business has a positive correlation to interest rates, so as interest rates rise, we'll see an increase in our rates of return. We've historically not seen any sort of a dip in merger activity as interest rates rise.
We've seen a lot of insurers get together because of Obamacare. How does the Kellner Merger Fund play this?
So we look at announced deals only. We don't do any speculation or anything like that. So when the deal is announced, we'll take a position on something when it's a definitive agreement. And what we do is we go long the target and short the acquirer, and we lock in a spread. And what that does is give us a rate of return that is uncorrelated to the market. So regardless if the market goes up 20% or goes down 20%, as long as that deal closes, we will lock in that spread. And we're seeing obviously a lot of deals lately, especially large deals in the healthcare sector. Large deals are good for our fund. They show better rates of return. If you think about it intuitively, the spread can be squeezed by just a couple of players on a small deal if it only trades light volume. But a large deal has natural buyers and sellers on any given day, so that the spread is affected by those trades. And then we have advantages to the opportunities to lock in that spread at wider levels in larger deals.
Well, let's stay in healthcare. Tell me your position on the Mylan Perrigo Teva dance. This has been a fun one. It's been going on for a while.
Yeah, it's interesting. You have two reluctant sellers here. You have Perrigo, who's getting taken over by Mylan, and Mylan's a Dutch domiciled company, and that's important from the Teva side because Teva's trying to take over Mylan. Being incorporated in the Netherlands gives you a little bit of an advantage because they have something called a stichting over there, a fun word to say, where it's almost like a poison pill, where there's a separate independent board that looks out for the shareholders of Mylan. So historically, in a deal like this, you would expect Mylan to succumb to the overtures of Teva because shareholders are going to want a premium to their deal. In this case, the Mylan shareholders, or at least the Mylan board, is telling you that the Perrigo deal is a better option for shareholders than taking the premium from Teva. And the words have been pretty harsh between the companies. You rarely see that kind of talk between boards of directors of two companies. Mylan basically saying that Teva is a bad company and the management's not doing a good job and they haven't done a good job. Usually you'll say something negative about a company and then you come together and you make up and you come to a deal. Here it looks like Mylan really doesn't want to get taken over.
And how do you think it'll play out?
I wish I had a crystal ball, but I think Mylan's in a good position here. Perrigo shareholders will probably benefit either from a Mylan deal, and I'm sure Perrigo's out there shopping themselves to other deals as well. And they're probably just looking for a higher price from Mylan, which I think we probably will get.
And then finally, I want to talk about the energy space. We saw the price of oil really come down in the fourth quarter of 2014, caused a lot of pain for the shale players. People thought that a lot of the bigger players were going to wait and then rush in and buy a lot of these battered shale players. It's not really played out as much as people thought. Do you expect that to pick up?
Yeah, we were a little bit surprised as well, but I think the bounce from oil from 40 to 60 is kind of what caused that. So now you're in the no man's land of where oil is. Is it going back to 40? Is it going to 80? If it's going back to 80, then they should be doing deals now. What that tells you is that there probably is some hesitation on the part of larger buyers thinking that oil may go back down. So it's hard to price a deal knowing that those valuations could get cheaper going forward. We'd expect probably the shale plays to start to get taken over if oil hangs out around the $60 value. Their cost of getting the oil out of the ground is closer to 80. So right now they're just producing to cover fixed costs. Sooner or later they're going to have to raise some money, and they're either going to go to the debt markets or get taken over. The debt markets are kind of closed to those plays right now because they know that they're in trouble. So their best bet is probably going to be getting taken over at some point in the future if oil hangs out around $60 a barrel.
And you like playing that arena?
We do. You know, we're not anticipatory in anything that we do, but we think that there will be a lot of M&A in the second half and in the first half of next year in that space.
You're in it for the deal. Thanks for coming by.
Thank you very much.
And thank you for watching The Street.